Every night while you're asleep, $4 trillion vanishes. Not stolen, not lost, just parked. Institutional investors, corporations, money market funds, they all show up at the same place at the same time, looking to stash an amount of cash so large it's almost incomprehensible. And the Federal Reserve is the valet. This happens every single night, and almost nobody knows it exists. Here's the thing about the financial system. We think of money as this static thing. You earn it, you spend it, maybe you save some of it. It sits in your account. Simple. But for the people who manage billions, money is a live grenade. Holding cash overnight is a problem, not because it might disappear, but because it's not earning anything. And in their world, money that's not working is money that's dying. So they need somewhere to put it, somewhere safe, somewhere that pays them. And they need it to be available first thing in the morning. No questions asked. Enter the reverse repo facility. If that sounds boring, stay with me, because this obscure corner of the financial system has quietly become one of the most important places in the global economy. And it's built on a very simple, very strange idea. The safest investment in the world is loaning money to the people who print it. Let's start with the basics. A reverse repo, reverse repurchase agreement, is a transaction where someone parks cash with the Federal Reserve overnight in exchange for Treasury securities. The next morning, they swap back. Cash returned, securities returned. The Fed pays a small interest rate for the privilege. Think of it like a coat check, except the coat is several $billion, and you get paid to leave it there. Who uses this? Money market funds, mostly. These are the funds that millions of Americans rely on for cash-like investments. Safe, boring, liquid. But also banks, government-sponsored enterprises like Fannie Mae, and foreign central banks. Anyone with too much cash and nowhere safe to put it. Here's why it matters. In a normal world, if you have extra cash, you loan it out. You buy bonds. You invest in something. But when interest rates are low, or when trust in the banking system gets shaky, or when there's just too much cash sloshing around, traditional options start to look unappealing. The interest you'd earn isn't worth the risk, or there simply aren't enough borrowers. So instead, you go to the Fed. You hand over your cash, they hand over a treasury bond as collateral. You sleep well. In the morning, you reverse the trade. It's boring, it's predictable, and it's enormous. In 2014, the reverse repo facility had about $50 billion in it on an average night. By 2021, that number had exploded to over $1.5 trillion every single night. Right now, as of late 2024 and into 2025, the balance sits somewhere between $300 billion and $600 billion, depending on the week. Still massive, still growing when things get weird. Let's put that in perspective. The entire GDP of Canada is around $2 trillion. The reverse repo facility at its height was bigger than that. It was holding more cash overnight than the combined market cap of Amazon and Google. And here's the picker. This facility didn't even exist in its current form until 2013. So what happened? Two things broke the old system. First, quantitative easing. After the 2008 financial crisis, the Fed started buying bonds in massive quantities to prop up the economy. They created new money and injected it into the banking system, trillions of dollars. And all that money had to go somewhere. Banks were suddenly flooded with reserves, more than they needed, more than they could lend out. They were required to hold some of it, but the rest just sat there, dead weight on their balance sheets. Normally, banks would loan that excess to each other in something called the federal funds market. That's how the Fed used to control interest rates, by influencing the price of overnight loans between banks. But with so much cash in the system, nobody needed to borrow. The federal funds market started to break down. Rates were drifting below the Fed's target. The whole mechanism was losing its grip. The Fed needed a floor, a way to set a minimum interest rate even when cash was everywhere. Enter the reverse repo facility. The Fed said, "We'll pay you this rate to park your money with us overnight, and because we're the safest counterparty in the world, that rate becomes the floor. If the Fed is offering, say, 5%, why would you accept 4% anywhere else?" Suddenly, the Fed wasn't just influencing rates, it was setting them directly, and it was doing it by becoming the biggest borrower in the room. Then came COVID. In 2020, the Fed unleashed another wave of quantitative easing. bigger than before. They bought bonds, backstopped markets, flooded the system with liquidity. The reverse repo facility swelled. But here's where it gets strange. In 2022, the Fed started raising interest rates aggressively to fight inflation. You'd think that would shrink the reverse repo balance. Higher rates mean better returns elsewhere, right? Wrong. The balance kept growing because the Fed was also paying a higher rate on reverse repos. As they jacked up interest rates across the economy, they had to raise the reverse repo rate to maintain control, and that made parking cash with the Fed even more attractive. So you had this absurd situation, the Fed trying to tighten financial conditions and slow the economy while simultaneously offering institutions a better deal than they could get almost anywhere else. Money poured in. At one point, the reverse repo facility was paying more than short-term treasury bills. Think about that. You could earn more by parking cash with the Fed overnight than by buying a government bond. The facility had become a black hole for liquidity. Now, here's where people start to panic. Some analysts looked at the reverse repo numbers and saw a crisis brewing. They said, this is proof the financial system is broken. Banks don't trust each other. Money markets are seizing up. It's 2008 all over again. That's not quite right. The reverse repo facility isn't a sign of dysfunction. It's a tool, a very powerful, very strange tool, but a tool nonetheless. It's doing exactly what it was designed to do: absorb excess cash and control rates. The real question is, why is there so much excess cash in the first place? And that's where things get uncomfortable. The Fed created this problem. Quantitative easing flooded the system with money. Then they raised rates to fight the inflation that followed. But they couldn't just pull all that money back out immediately without crashing markets. So instead, they built a facility to manage it, to warehouse it, to keep it from spilling into places it shouldn't. The reverse repo facility isn't a stopgap. It's a symptom. It's proof that the financial system is running on so much manufactured liquidity that traditional tools don't work anymore. Banks have more money than they know what to do with. Investors can't find safe returns, and the Fed has become the lender, the borrower, and the backstop. Here's what should worry you. The reverse repo facility has made the Fed indispensable, not just important, indispensable. Before, the Fed influenced markets. Now, it is the market. If the facility disappeared tomorrow, hundreds of billions of dollars would have nowhere to go. Money market funds would scramble. Interest rates would spike. The whole overnight lending system could lock up. The Fed has built a dependency, and dependencies are dangerous. There's also a darker possibility. What if the facility becomes too attractive? What if during the next crisis, banks and investors pull money out of private markets and stuff it all into the Fed's vault? That's called disintermediation, and it could starve the real economy of credit at exactly the moment it's needed most. The Fed has already seen glimpses of this. During moments of stress, the reverse repo balance surges. It's a safe harbor, but if everyone rushes to the harbor at once, the harbor becomes a trap. And here's the part nobody talks about. The Fed is paying interest on all this cash. Where does that money come from? The Fed's own balance sheet, which means indirectly from taxpayers. We are subsidizing the storage of institutional wealth. In 2023 alone, the Fed paid out tens of billions of dollars in interest to reverse repo participants, not to stimulate the economy, not to help struggling borrowers, just to park cash. That's not a conspiracy. It's just how the system works now. But it's worth asking, is this really the best use of public resources? So every night, trillions of dollars get vacuumed into a facility most people have never heard of. It's invisible, it's automatic, and it's holding the financial system together in ways we're only beginning to understand. The Fed will tell you this is temporary, that once they shrink their balance sheet and normalize policy, the reverse repo facility will fade into the background. Just another boring tool in the toolkit. Maybe, or maybe we've crossed a line. Maybe the system is now so large, so complex, and so dependent on central bank intervention